So good morning all. Thank you so much for joining. Thanks for taking your time on a Sunday morning. And we did this few sessions before actually, during the COVID times when the market was extremely volatile, so that we shared some ideas and we wanted to see what is the best way to invest. And I thought after that the market has been kind of fairly smooth. But then the inflation happened, and then the last few months have been extremely volatile. So we thought it's a good time to basically have a catch-up, share some ideas, and so that we will actually have some clarity on what we want to do. So for the benefit of those who are actually new and probably don't know me as well, so we'll give a small brief introduction before we talk about what are my thoughts in current market situations. And also we would like to hear from everybody so that we actually understand what is happening and everyone's perspectives. So for those of you who don't know, I'm actually working for a company called Vincent Financial, representing AIA for more than 25 years. I'm an MDRT qualifier for the last 7 years, and I have over 12 years of experience in this industry. And before that, I used to actually invest for myself. So I always believe some of the best life lessons are learned at the worst times, right? I'm sure you all will agree with that. But I always tell all my clients there are two kinds of lessons learned. One lesson, which is basically for risk management, we actually learn from other people's experience. We can't buy an insurance policy after somebody is diagnosed with a major illness. We can't buy a hospitalization plan after a heart attack. So we just know the cost. We know the cost of somebody not learning their lessons. So we learn their lessons basically from other people. But when it comes to investments, it's better we learn it by ourselves by just putting in the money. We just wait for sidelines. People say I've made 10% growth, 15% growth. We will not learn anything. And you will not have the connection to actually start investing. So it's always the investment lessons, we learn it ourselves, but we don't wait for the risk management lessons to be learned by ourselves. So there are two aspects to financial management, risk and wealth. So risk we are not going to talk in today's value. I just want you to be aware. Basically a good health insurance, a good critical illness plan, a life insurance and an accident plan. Recently, I met a friend whose father on LTVP actually had a massive heart attack and they had to spend $150,000. So you can imagine the cost of something not properly planned in Singapore. So the next aspect of financial management is basically wealth management. So wealth typically includes your medium-term options like your kids' education plan, a retirement plan, then short-term options like I want to buy a car, I want to buy a property, and actually have some contingency plan in some liquid investments. So all these things, something you need to be aware. And if you need to know more in detail, please feel free to ping me and we will actually have a catch up separately on that. So what is the smart money? How do I manage my money? Like for example, if I save a certain amount of money, how do I split it? So typically what I advise all my clients is if you actually save $6,000 per month, you put it in $2,000 in some fixed long-term investments, $2,000 in flexible short-term investments, and $2,000 in flexible long-term investments. So the difference between flexible short-term and flexible long-term is basically not commitment. So you can be fine if you don't commit for yourself next month, but ideally you would want to keep it so that the long-term plans are in place. But at the same time, we can't commit everything for a fixed commitment because things can actually go wrong. So it's very important to know how do we actually allocate our savings for investments. So, and also it's important to start early. For example, if I want $1 million at age 60, when I start at 30 years and if I earn 6%, all I need to do is set aside $1,000 per month. Whereas the same thing, if I start at 40, it's actually $2,100 per month. And 45, it's $3,500 per month. So the question we keep asking is, will your expenses be more when you are actually 45 compared to 30, right? So the inflation, the kids' education, extracurricular activities, your commitment levels, everything is going to be much higher. And very, very rarely the salary actually catches up with that kind of a escalation. All right. So if you cannot save $1,000 at 30, how am I going to save $3,500 with much increased expenses? So it's always better you start off early. So the power of compounding can work in your favor. We have done a lot of plans for kids at a young age. You start when they are born, 5 years, 10 years. So you pay as a parent for 10 years, then they can start taking over. Then in that case, they need to set aside only $1,000 to get to $6 million, $8 million, for example. So it's always easier to start early so that the money works in your favor. So what are the investment options? Basically, the options by which you can deploy your money is endowment and investment linked funds. Endowment is getting very, very difficult because the interest rates are falling further and further. So for example, the endowment plans, what they offer now compared to 10 years before is very, very, low, and it's not very attractive as an investment option, even though it's fairly safe. Mutual funds, equity, that we'll actually see a bit more of each of these types. Of course, fixed deposits are another problem, which is basically the interest rates are getting lower everywhere. India, for example, lowered the interest rates from 8.5 to 8.1. So the long-term real interest rates will be much lower compared to the last 20 years ago. So when you plan for retirement, you cannot bank on fixed deposit as an investment option. Of course, stocks, it comes with a higher risk. So I would just like to touch in terms of sharing the thoughts, right? This is something I wanted to discuss. This is more for people who are not familiar with it. For people who understand, it may not mean much, but I just want to explain what's my thoughts, my rationale on these things. So for example, what is the best time to invest in each of these instruments? So would anybody like to basically answer these questions? I can just put it in a mute all. So what is the best time to invest in equity? What is the best time to invest in bonds? Or what is the best time not to invest in money markets? Does anybody has any idea? Would anybody like to share their thoughts? You can unmute and share your thoughts if you have some opinion. Okay, so probably what my feeling is, generally you would want to avoid an equity during a recession. You would want to avoid an equity probably when the interest rates are going up a bit. These are some of the times when the equity can actually have a bigger impact. And of course, some uncertainties like what has happened with COVID, because we don't know what will be the impact to the global economy. And then we have situations like geopolitical tensions, the wars that is happening. So those are the time typically you avoid, or that is the time you have to relook at your equities, right? When it comes to bonds, interest rate plays a big role in bond pricing. So as the interest rate goes up, like what was actually been discussing the last few months before the war has started, there seemed to be a case for an aggressive hike in interest rates because of the inflation. So that is probably, I personally feel it's moderated a bit because of all this uncertainty with relation to the war. But again, that is the time you would want to avoid investing in bonds. The same thing, when do you want to invest in fixed income is at a time when you think the interest rate cycle is going to go down, so there will be an increase in bond prices. Even though as the interest rates goes up, the yield increases, the fall in prices of bonds will not be able to offset the increased yields. So you should know there is a time when bonds can be attractive, there is a time both bonds and equities can be attractive, there is a time when neither of them will be attractive. Then you park your money in money markets. So what is the picture now? So if you take the picture now, I think it's common sense that inflation is hitting through the roof, and actually it's actually worsened with the war. But at the same time, a lot of people are saying this inflation, these supply chain issues, and the geopolitical uncertainties will probably cause a recession as well. So there is a lot of these theories going around. Some people say there could be a recession. Some people could say inflation is going to be much higher. And the central banks are slightly moderating the tone in terms of hawkishness, not as much as before the war. And I think they would want to risk by hiking it too fast, especially given the uncertainty. So to me, I think personally, I feel the interest rates will have to go up considering the inflation, but at the same time, it may not actually go up as much, and there are also some liquidity constraints which are being spoken about now. So the uncertainty because of geopolitical is there, but at the same time, I think people would want to wait and will not be as aggressive, which is already factored in the Fed funds rate as well. So this is what I feel in terms of the macro now. So like I said, when do you invest in equities? When do you invest in fixed income? When do you would like to be in cash? There is also a similar strategy. There is no right or wrong on all these things. It's about, what is your conviction level for each of these things. Similar to what instrument, there is also the investment strategy, whether should it be a single lump sum investment or should it be a single systematic dollar cost averaging kind of investments or some random investments as and when I have money I will invest, right? So I'll briefly touch upon when is the right time to invest a single lump sum. So a right time to invest a single premium or a lump sum investment is when the market is extremely fearful, right? But unfortunately, in most of such scenarios, we are actually part of the fearful group and we don't actually have the courage to put in new money, or our portfolio is already bleeding and we are very fearful, or we don't have the money to basically buy more. That's what typically happens in a single premium investments. Regular systematic investments, what many don't actually tell is what is the entry point and exit point. So for example, if a single premium investments, if you've done in March and probably by last September, October, you would have actually gotten, if you look at the US funds returns for the last 12 months, it's actually around 30% before the fall. And if you look at India, it's actually around 25%. The question we got to keep asking is, I put in a single premium and my average expected return is 6 to 8%. I've got 30%. Am I happy with that, right? But the problem is many of us will not actually, we think, oh, why rock the boat? It is going fine and we don't want to exit. So the suggestion is you should actually have an exit strategy and a very clear-cut exit strategy, and don't wait for, see, all these wars, all this COVID stuff, even though it causes an impact, it's unexpected. These are just excuses or the reasons. For example, like 1 month ago before the war, the interest rate was used as an excuse for the markets to fall. When the market is really overheated, when it is overbought, when the expensive valuations are really expensive, markets will find a reason. It can be a small thing, it can be a big thing. For all you know, even with these wars, if things appear to be a certain, for example, war is now it's a known, right? So it was actually, the market was fearing when it was a known unknown. Now it is a known. They know this is what is going to happen. Of all you know, war could actually get worsened from here, but the markets might even move up if the Fed says we are not going to raise rates. We will probably start buying bonds again. You don't know, start selling bonds again. So they can actually free up all this liquidity again. Then the markets get rally irrespective of what is happening with the geopolitical situations. So it's very difficult to predict these things. But the only thing what we can actually focus is the price right for what we are getting in, right? For example, I'll give you a couple of examples like HDFC Bank. I mean, the company is doing phenomenally well. There are some impacts in their net interest income, but the company is a solid company. If India continues to grow at what they are saying over the next few years at 8%, 10%, HDFC will grow at 20%. There is no doubt about it. And look at the growth in AIA, for example. If you look at the results, AIA announced results yesterday. It's phenomenal. They are growing in this environment. And if you look at what they are saying they will actually buy back close to 10 billion worth of shares over the next 3 years. So that is the amount of capital that they have got. That is how much they think the shares are cheaper. and the shares has actually fallen from $110 to $75. So it does make a lot of sense to buy some of these stocks at good valuations. So the best time to make the good buys is during the worst times. So as I said, the best time to get rid of the bad stock is during the good times, and the best time to buy good stock is during the bad times. So there are a lot of such investments which are available, right? So as much as we need to worry about these things, but we need to have a strategy which can actually mitigate all of these things. So typically a single premium investment is done when the market is actually at low. And when you think, okay, things can't get any worse than this, I'm comfortable doing it, right? So that is when you do a single premium investments. If the investment return on single premium exceeds 2 or 3 times than your long-term expected returns. So for example, I'm expecting 6 to 8% returns. The market has given 30%. It is not a sustainable rate of return, right? Then probably that is the time you actually move from a single premium investment to a dollar cost averaging or a systematic investment model. So this is for single premium. Then the regular premium, right? If you do a regular premium systematic investment dollar cost averaging, like SRS, for example, we do a lot of SRS. People doing their SRS, they say they want to be very aggressive with their investments. And they say, I don't mind taking risk. It's a long term, right? So for example, we put in the money and we put in money in China, for example, or India last December, any equities, for example, then the market falls 15-20%. Then they don't have the courage to put in the next year of money. So that is what we are trying to address here. Don't worry about if you're doing a dollar cost averaging, if you're doing a systematic investment plan, the reason why you are doing a systematic investment plan instead of a single premium is because the markets have fallen and the markets are at the peak. You expect the markets to actually be volatile and it will probably be lower at some point of time, but you don't know what will trigger it. That is the reason why you don't want a single premium investments and you want a systematic investments. So there will be parts once you start, it can happen after 1 year, it can happen after 2 years, the markets can go down. But that should not actually deter you from continuing with your systematic investment plan because that is the time you will be buying units at much lower prices. So continue with your SRS investments or your regular dollar cost averaging plan if your returns are impacted, because that is where you will probably make money because you are going to buy units at lower prices. So what is the exit strategy for dollar cost averaging? That is again the same thing. It depends on when. See, for example, if my expected rate of return is 6 to 8%, if the rate of return hits 18 to 20% on your dollar cost averaging returns, then basically after a period of time, right? So you have to actually consider the time factor also when it comes to long-term dollar cost averaging plans, which nobody talks about. Actually, if you're, I'm not sure if any of you are here, but I spoke to a lot of my clients in October, November, December period, where if you look at the rate of returns in India or any other plan, for example, it's far exceeded 20%. And people don't want to listen to you, right? When you say, oh, 20% returns, you exit the markets, you start a new dollar cost averaging plan. People think, oh, no, it's already going fine. Why should I change it? It's working very well, and there is nothing which can actually disturb that, right? But my point to all my clients at that point of time, I don't know what will disturb this, but what I know for certain is there will be a fall at some point of time, right? This 20% of dollar cost averaging or 30% of yearly returns is not sustainable. So my point at that time was, in December, what I was advising all my clients till this September to December was, if you're, for example, doing a dollar cost averaging plan in Singapore or in India, if you're contributing, say, 50,000 rupees per month or $1,000, you exit because you got 18 to 20% return, which is probably double the long-term return for the next 10 years. Even if you don't earn for the next 5 years, you're happy because you got more than what you want. So now it's a time, because I don't know when the markets will fall, but you have a cash because you invested for the last 10 years, right? So you withdraw, for example, 50,000 over the period of 10 years, 20 years. You withdraw that. Instead of 50,000, you start with 1 lakh because you have the money. But at any point of time, when the market falls more than 10%, 15%, like what it is now, then you can actually put in lump sum investments because you're already getting at a 10% lower. So it's very important for both of these strategies. These are the only two strategies. For both of these strategies, you need to have an entry and exit idea, exit strategy, so that you don't actually get caught with just one big move or one such situation like what it is now. So that is what we discussed. What is the best time to invest in each of these things? I'll be happy to take these questions later. And then exit and entry strategies for regular dollar cost averaging, or for sometimes people don't buy at regular intervals, but they buy at every 5% lower levels, right? So that is another option for you to consider. So what are the do's and don'ts? These are basically, it's fairly straightforward. Focus on every asset allocation, not on based on valuations. Diversification as much as possible, especially the more you grow, the more your portfolio grows. Don't invest all your money in single basket, right? Like we know what is happening with Russia related. Some of the energy stocks have gone down from $250 to 50 cents. So that is what sometimes some sectorial specific funds can actually have an impact. The commodities are going through the roof, but at the same time can fall at the same pace. So try to avoid sector-specific funds unless you are very sure you have the expertise to basically understand the commodity cycles and how the pricings are impacted. Don't speculate. Don't try to get for 2 months, 3 months. If you actually signed up for a plan like dollar cost averaging for 10 years, don't worry about the shortfalls the first 6 months or first 2. If it's all fine for the next 10 years, have a plan for an exit strategy. So avoid like very small economies, small countries with one small impact and have a significant erosion in your portfolio. So why exit strategy is very important? Because generally very rare that I see people invest more than 10 years even for SIP. There are very few people who are extremely market savvy are the ones who actually have a more than 10 year, 15 years visibility. Let's just see an impact, right? For example, if somebody has started a portfolio in 2012, when the markets are recovering, they think it's the best time to invest. They start putting in $1,000 per month. Actually, I put in $10,000, $12,000. At rate of returns of 6%, which was quite likely before December or before this crash. So the $120,000 what you have invested at 6% actually is become $160,000, right? But for $160,000 to come to break even, that means basically all your 10 years of efforts of investments going to break even or becoming zero is actually requires only a 20% fall. Is 20% fall quite likely in any 10 years time frame? If you historically see the graph, it probably would have happened almost every year, or if not at least once in 2 years. It has happened in March 2020. It's happening now. If you look at NASDAQ now, it's actually given up all the gains of 2021 and it's below. It's at 2020 levels. So NASDAQ has fallen to more than 20%. India has fallen. So Hong Kong has fallen. So S&P is not too far. Dow is not too far. So if you look at take a 10 years, why exit strategy is important for SIP? Whereas if you're actually happy with 6%, 10% over a period of 10 years, you can start another cycle again. There is absolutely no problems. But why it is important? Whereas probably if you actually been investing over a period of 20 years, maybe then it's not, the impact is not so much for a 20-30%, but it can also have a significant drop in your rate of return. So 8%, 10% can easily come down to a normal 4 to 5% with just 1 or 2 falls. So the point at which it falls. So if I'm doing a dollar cost averaging, if it falls within the first 2, 3 years, 5 years, it's not so much of an impact. But if it falls after 10 years, after 20 years, when there is a significant fall, then we actually have a bigger problem. For example, the fall in March 2020 would have taken out last 20, 30 years of your gains because the markets fell 40, 50%. Right? So it's quite likely that one big fall shock somewhere, and also it's very unlikely for somebody to invest money and not to use it for next 10, 20 years because you need that money at some point of time. So this is what you need to know and why exit strategy is important for this. And also the other thing is time in the market is more important. Exit strategy is important, doesn't mean you're out of the market, but you need to be in the market. What is the strategy for that time is what you need to basically be aware of. So for example, these are some of the funds. If you look at the 1 year return of regional equities minus 7.7%. So for example, if I actually started a SRS account, if somebody says I want to be aggressive and invested in regional equity, China equities, market is down. So they actually most likely, even though they want to be aggressive, they think, oh, it's not working fine, I don't want to put it. Actually, if you really look at it, you are getting 15% lower compared to last year. So would you actually be keen or not, right? But sometimes this is where the experience comes in. So for people who don't actually have the fear, for people who have seen enough of markets, take these as opportunities. So if you're new to investments, don't worry about this, because this is a better time for you to actually add more. And I personally believe this is a great time to start your retirement plan or for investments for the next 10 years perspective, because you will definitely get the economy is going to be restarting with all this pandemic stuff, with this war, and I'll show you some data about what is the impact after the war in many of these equities. So the long term, if you actually hold on, for example, the India Equity Fund since inception, which is basically for more than 20 years, has given a rate of return of 10%. And if you look at the 1 year return for US is actually 30%. So if you look at 30%, is it sustainable that this can actually continue to grow further? The chances are very less, right? And we all know, but sometimes we don't act on it. So that's why it's very important. These are some of the messages that's been going around why you should buy this. But there is also a lot of fear. There is a lot of uncertainties. We don't know how things get escalated. But how many of us will even remember the impact of a Gulf War or a Crimean crisis or a Iraq war, right? We might just say, oh, it happened. Hindsight, but now when the market keeps going down 5% every day, even 1 week looks very difficult. But actually, if you take a perspective, 10 years down the line, 5 years down the line, we will say, yeah, it was down for a month, but probably that was the best time to buy. If you look at COVID now, things started getting worse. Actually, Singapore announced the circuit filter in February, right? But actually the market fell much later in March, only when the US starts having some difficulties, when the beds were full in US. So people thought it's fine, COVID is there, but it's still fine. Markets didn't react for it. A lot of my clients actually wanted to short the markets when the circuit filter was announced, but nothing happened. It started to go up and up. But when things did fall, it was really, really scary. So the same thing, Rao. Probably the next 2 weeks, next even a month or so might be uncertain. But the moment the markets have visibility, we will not be able to buy it at the price that is currently now, or probably will be available over the next few weeks. So this is what the history says. And probably if you are very, very uncertain about where things are headed, it's a good time to start a systematic investment plan. But it's a great time to be in equities either way, through a single premium or a systematic investment plan. Just to be on record, this is the first time I just want to have a disclaimer here. This is no means a recommendation. This is just to let you know. For the first time, I've never used my CPF savings for investing in stocks. But for the first time, ever since I started actually putting money into CPF, I am investing into equities using CPF money, because I think the chance of you making more than 4% returns from here is very, very high. So that is the kind of conviction that I have. I think things will have to only get better from where we are now. So what is important is doing it once, more importantly doing it right. Because if you have a plan, stick to the plan because you believe the plan is good. Don't keep changing the plan just because of some market fluctuations. Diversify your portfolio across geographies, across currencies, across asset classes. Maximizing your investment returns with tax rebates like SRS and other options, whatever that you are eligible for. And do a cost benefit analysis when you're buying a stock, or is it worth the price that you're paying. So if HDFC was $85, just 3 months ago, if it is available at $55, why should you not buy it, right? Is there something wrong with the businesses? There are some businesses you don't understand. There are some businesses you don't know, like how it works. For example, there are a lot of these electric vehicle companies are soaring, right? I don't even know. Many of them are reporting huge losses. And what will happen to this cost of the commodity for their batteries and stuff like that, right? So if you're not sure, don't worry about it. All you need is 3 or 4 ideas and just stick with it, and that is enough to make money. So choose a style that suits your risk profile. Don't do something just because I think this is what makes sense. You don't be adventurous because I say this is a good time to invest in markets, or you don't be conservative just because somebody says this is not a great time. You understand the style. The risk appetite varies for each and everybody, right? So you understand the style which actually suits your risk profile so that you know what you're doing. So finally, I'm happy to take questions. Don't keep me a secret. Please refer you to all your friends. Personally, I think this is a great time to start your retirement plan because the power of compounding can work in your favor. If you're not very sure about whether it's the right time, start with the dollar cost systematic investment plan or a dollar cost averaging plan. As the market keeps going down with every 5% fall or a 10% fall, keep adding more money so that you're actually getting much more at lower prices. If you start with the dollar cost averaging plan, you put in $10,000. Don't worry if the market falls 10%, but put in the next $10,000 because eventually market has to catch up, right? So this is what I would like to share. I'm happy to take questions now. Please feel free to unmute yourself, or I'll press a Q&A, so you can just press Q and question and ask your question. Thank you so much for your time today. Hope you find the session to be useful. If you have any questions, please